Open whatever news app you use. CNBC, Bloomberg, Reuters, doesn't matter. What's at the top? I'd bet money it's Trump landing in Beijing, or stocks fading after Tuesday's CPI. Maybe Kevin Warsh getting confirmed to the Fed. What you will not see anywhere near the top is the number that actually matters this week. Silver is trading around $87 an ounce as I sit down to record this on Thursday, May 14th, 2026. That's a fresh 2-month high. It's up about 172% over the last 12 months. And in the last 48 hours alone, silver has ripped through 3 price levels that JP Morgan and Bank of America told their clients we wouldn't see until 2027. So why isn't this the headline? Silver going vertical while the financial press is busy debating whether the S&P had a healthy correction it's a choice. It's an editorial choice. That's what I want to get into today. Because the moves stop looking crazy once you see what's actually underneath this market. The people who've been pounding the table on silver for 2 years aren't being proven right by some conspiracy. They're being proven right by basic supply and demand arithmetic that the mainstream coverage keeps ducking. I'm going to walk you through 5 things in the next 20 minutes. The CPI print from Tuesday. The energy crisis nobody's calling an energy crisis. The Fed transition that almost no one outside Wall Street is paying attention to. The supply situation in the silver market that the Silver Institute itself is now officially calling an era of reduced stocks. And finally, what the Trump C summit happening today and tomorrow could mean for all of it. Stay with me. This one connects a lot of dots. Tuesday morning, 8:30 a.m. Eastern. The Bureau of Labor Statistics drops the April Consumer Price Index, headline inflation, up 0.6% in 1 month, 3.8% year over year. That's the hottest reading we've seen in almost 3 years. Core inflation, which strips out food and energy, 2.8%. Both numbers came in above what Wall Street expected. That part you probably heard. Here's what you didn't hear, because it was buried in the back of the report, where nobody but bond traders and policy nerds bothered to look. Real wages, meaning what your paycheck actually buys after inflation, fell 0.5% in April alone. They're down 0.3% on the year. Let that sit for a second. The average American worker on the government's own data is now losing buying power, not on some podcast guy's spreadsheet, on the official tape in writing from the BLS itself. That is a big deal. And it explains why the energy component of this report is so important. Gasoline up 28% year over year. Fuel oil up 54%. Airline tickets up 20% in 12 months. The energy index alone accounted for more than 40% of April's entire inflation jump. Now, why is energy doing this? One reason: the Strait of Hormuz. Roughly 20% of the world's traded oil used to move through that strait every single day. Used to being the key phrase, because since late February, when the conflict with Iran kicked off, that route has been effectively closed. WTI crude is trading above $112 a barrel. Brent is above $117. Saudi Aramco's CEO, Amin Nasser, came out and said it straight. The world is losing about 100 million barrels of supply every week the strait stays shut. And if it doesn't reopen soon, we're not looking at a normalized oil market until 2027. The U.S. Energy Information Administration confirmed all of this in their May outlook published Tuesday. Global oil inventories are drawing down at 8.5 million barrels a day. Brent is expected to stay near $106 through June. This is the inflation backdrop. Energy prices are not coming down. Wages are not keeping up. The Fed's 2% target is starting to look like a punchline. And in that environment, silver at $87 isn't a bubble. It's a thermometer. This part is genuinely strange, and I don't think most people have processed it. On Monday, the Senate voted 49 to 44 to advance Kevin Warsh's nomination to the Federal Reserve Board of Governors. The confirmation vote to install him as the next Fed chair is expected this week, before Jerome Powell's term as chair officially ends on Friday, May 15th. So far, normal transition. Here's where it gets weird. Jerome Powell, the outgoing chair, has confirmed in writing that he is staying on the Fed board through January 2028. He's citing the open Department of Justice investigation into those Fed headquarters renovation cost overruns as the reason he's not leaving. So starting Friday, the United States Federal Reserve will effectively have 2 chairmen sitting in the same boardroom. Kevin Warsh in the chair, Jerome Powell still at the table. And here's the kicker. Kevin Warsh is a hawk. By every published measure of his record, the man is a monetary hawk. He served on the Fed board from 2006 to 2011, and he dissented against quantitative easing back when QE was still considered radical. He spent the last decade saying the Fed cuts rates too easily and tightens too slowly. He's walking into a job where inflation just printed at 3.8%. Real wages are falling. Energy is supply constrained, not demand constrained. The futures market is now pricing a 30% probability of a rate hike by year end. Traders are pricing over a 70% probability of a hike by April 2027. A few weeks ago, the consensus was that the Fed would be cutting rates this year. The consensus is now dead. Done. Buried. Now look, here's the textbook bear case against silver in this environment, and I want to be honest about it. A rising rate environment is a headwind for silver. Silver pays no yield. If you can earn 4.5% on a treasury note, the opportunity cost of holding metal that just sits there goes up. The dollar index strengthened after Tuesday's CPI. 10-year yields hit 4.45%. These are real pressures. So why isn't silver selling off? Because the bond market is telling you one story, and the metals market is telling you a different one. The bond market is pricing higher rates from the Fed. The metals market is pricing the fact that even if the Fed tightens, inflation isn't going to come down, because the inflation is being driven by energy supply problems and wage price dynamics that monetary policy can't fix with a rate hike. You can't print more oil, you can't QT your way to a reopened Strait of Hormuz, and when the central bank can't actually solve the inflation problem, hard assets get bid regardless of where rates go. That's the dynamic. Hold on to it. It explains everything that follows. Okay, let's talk about the part of this market that almost nobody on financial TV ever discusses, because it requires actually understanding how silver gets dug up and where it ends up. The Silver Institute, that's the industry's own research body, not some gold bug newsletter, released their 2026 World Silver Survey on April 15th. The report uses a phrase I want you to remember: era of reduced stocks. That's the language from the industry itself, not from a YouTuber, not from a hedge fund pitching along, from the people whose job it is to track how much physical silver exists in the world. What they mean is this: for 6 straight years now, since 2021, the silver market has been in a structural deficit. We are using more silver than we're producing every single year. The deficit projected for 2026, about 46 million ounces. Add up the 6 years and the world has burned through roughly 762 million ounces of above-ground silver inventory. That's about 23,700 tons of metal that used to sit in vaults and warehouses and is now gone, consumed in solar panels, electronics, EV components, and increasingly investment. Now here's where it gets uncomfortable for the bears. Last October, the London Bullion Market Association vaults, which is the central hub of the global physical silver trade, held about 884 million ounces of silver on paper. Sounds like a lot, right? Except only about 150 million ounces of that was actually free to deliver. The rest was already leased, allocated, pledged, or otherwise tied up. So the real free float was around 17% of the headline number. When industrial demand tightened against that thin free float in October, the 1-month silver lease rate in London went from 1% to over 30% in a matter of weeks. 30%. On a monthly basis. To borrow silver, that is not a market in equilibrium. That is a market that almost broke and managed to grab the railing on the way down. And nothing has structurally changed since then. The free float hasn't recovered. The deficit is still running. Now layer on what happened this week. Peru, the second largest silver producing country in the world, responsible for about 13.6% of global mine output, declared a national energy emergency on Monday, May 11th. Their entire mining stack just hit a power crisis. Mineral processing, logistics, so the whole production chain is now operating under emergency conditions. And the market has barely processed this yet. Here's the part that makes the supply story even worse. About 74% of the world's silver is produced as a byproduct of mining copper, lead, and zinc. That means even if silver hits $200 an ounce, mining companies can't just decide to produce more silver. They produce what comes out of the ground when they're mining other metals. The price signal doesn't really work the way it does for, say, oil. So we have a 6-year structural deficit, a free float that's already been stress tested once, the second largest producer in a state of emergency, and mine supply that physically cannot respond to higher prices in any reasonable time frame. This is why the Silver Institute used the word era, because eras don't get resolved in a quarter. They resolve across cycles, and they tend to resolve violently at the exact moment when most people aren't paying attention. Right now, as I'm recording this, Donald Trump is in Beijing. He landed Wednesday evening, local time. He's meeting Xi Jinping today and tomorrow. It's the first U.S. presidential state visit to China in almost 9 years. On the agenda, trade, Taiwan, AI, rare earths, and Iran. Trump told reporters before he left that the talks would be more than anything else about trade. Tim Cook, Elon Musk, Jensen Huang, and over a dozen other American CEOs are with him. Here's why this matters for silver. China is, by any honest accounting, the dominant player in the physical silver market. Chinese entities hold enormous physical inventories. China dominates the solar panel supply chain that drives industrial silver demand. And China holds the rare earth and upstream reagent leverage that it already used last year, when Trump pushed tariffs above 140%, and Beijing essentially shut off the rare earth tap until Washington backed down. The Council on Foreign Relations published their pre-summit analysis last week. Their language was striking. They wrote that China is going into this summit with the upper hand. That's not a phrase American think tanks use lightly about American presidents. The reasoning? China's economy grew 5% in 2025, despite the tariff war. They successfully pivoted exporters away from the U.S. market. They've made real progress in chip self-sufficiency. And meanwhile, Trump is heading into brutal midterm elections, needing wins to put on television, like big Chinese agricultural purchases, like Boeing orders, like anything tangible. China knows this. So when Trump asks Xi to help reopen the Strait of Hormuz, which is what CNN is reporting will be his biggest ask, Xi has every incentive to extract something painful in return. Concessions on Taiwan, lifting tech export restrictions, removing Chinese companies from U.S. sanctions lists. How does this connect back to silver? Two paths. If the summit goes well and Xi helps reopen the strait, oil prices crash, the inflation pressure eases, and the Fed gets room to stay on hold. That's actually mildly bearish for precious metals in the short term. But if the summit goes poorly, or even if it produces the modest, vague stabilization that most analysts expect, the oil situation stays where it is. Inflation stays elevated. Real wages keep falling. The Fed walks into the worst transition with no easy answers, and silver keeps doing exactly what it's been doing. The summit is the wild card. What comes out of those rooms on Thursday and Friday could swing the metals tape by 5 to 10% either direction within hours. Now look, I don't want to be the guy who only tells you one side of this. The bear case on silver is real. It deserves direct engagement, not dismissal. Silver at $87 is still about 28% below its all-time intraday high of 121.67 set on January 29th of this year. We've already had one major spike and a major pullback. The Reuters consensus for the 2026 average silver price is about $79.50, already below where we're trading right now. JP Morgan's full-year target is $81. Both of those imply that current prices are above what professional forecasters think is sustainable. Solar demand, which is a huge part of the industrial silver story, is actually expected to decline about 7% in 2026, according to Bloomberg NEF. Why? Because manufacturers like Longi and EcoSolar are aggressively rolling out new cell technologies, copper paste back contact cells, silver-free heterojunction designs that use less silver per panel. That's a real headwind that the bullish narrative often ignores. And the iShares Silver Trust, despite the 162% 12-month return, still has 3-month net outflows of $2.8 billion. People are taking profits at these levels, not piling in. The Atlanta Fed's GDP Now tracker has Q2 U.S. growth running at 3.7% on early data. That's not a recessionary environment. And historically, silver does best when the economy is contracting and people are scared, not when GDP is humming along. These are legitimate points. A responsible person weighs them, but then you weigh them against the other side. The Sprott Physical Silver Trust now holds 216 million ounces of fully allocated, unencumbered silver in Royal Canadian Mint vaults. Coin and bar demand is forecast up 18% this year to 227 million ounces, a 3-year high. Russia has formally added silver to its sovereign precious metals reserves, the first major central bank in modern history to officially classify silver as a strategic monetary asset. The World Gold Council reports 95% of central banks expect global gold reserves to rise in 2026, up from 81% last year. When central banks move in a direction, they don't move for one quarter. They move in volume over years. And here's the one that gets me. Bank of America's published 2026 silver target architecture puts the upper bound at $139 per ounce. Not Peter Schiff, not some YouTuber. Bank of America. That's 60% above where we are right now from one of the most conservative research desks on Wall Street. So when you look at it honestly, the bear case is mostly about a price level. The bull case is about how the market is actually structured. Those are not the same kind of argument. One is a forecast. The other is a foundation. I'm not going to tell you to buy anything. That's not what this channel does. What I can do is tell you what I'm watching over the next 4 weeks and why. First, the Beijing summit results. Today and tomorrow. Specifically, watch for any concrete commitment from China on the Strait of Hormuz. If Xi publicly agrees to push Iran toward reopening, oil crashes and metals consolidate. If he doesn't, the situation gets worse, not better. Second, Kevin Warsh's first public statements as Fed chair. He gets confirmed this week. Whatever he says in his first press appearance will be parsed by every bond desk on the planet. If he sounds aggressively hawkish, you'll get short-term metals pressure. If he sounds more measured, you'll get a melt up. Third, Peru. The energy emergency just started. The supply impact will show up in output data over the next 4 to 6 weeks. If Peruvian mine output drops meaningfully, you have a real shock on top of an already tight market. Fourth, the LBMA free float. It hasn't structurally recovered from October. If lease rates start spiking again, and you can watch the 1-month lease rate in real time, that's the signal that the squeeze is happening for real this time, not as a stress test. Fifth, the data calendar. Producer price index this morning. Initial jobless claims Thursday. Retail sales next week. Each of these is now a high-stakes print because the Fed transition is happening in real time. This is the kind of moment where most people are going to want to either panic buy or panic sell. Neither is what disciplined people do. The disciplined response is to understand the structure, watch the signals, and make decisions on your own time frame, not on the time frame of whatever happens to be trending on financial Twitter. The story everyone is telling, that this is just another commodity cycle, just another inflation scare, just another moment of geopolitical noise that will fade in a few weeks, that story has been wrong for 6 years running. The Silver Institute is now publicly using the word era. The Federal Reserve is changing hands. The Strait of Hormuz is closed. Peru's mining sector is in a state of emergency. China is sitting on the leverage. And the financial media is talking about whether the S&P had a healthy correction. I'm not saying silver is going to $200 next month. I'm not saying it can't pull back 15% next week. What I'm saying is that the structure of this market has changed. The conversation has changed. And if you only listen to the people who get paid to keep you comfortable, you're going to miss the part where it changes most. Standard disclaimer. This is for education and analysis. None of this is personal financial advice. Do your own work, use your own judgment, and make your own decisions with your own risk.